Today's economic landscape is marked by uncertainty, especially concerning inflation and cryptocurrency. Many investors find inflation complex, with younger generations finding it particularly perplexing since they haven't experienced it firsthand. As they work to build wealth while managing rising costs, like housing, inflation's impact becomes harder to ignore. In a recent discussion with Bro, finance expert James Lavish warns that the public might be overlooking indicators of an impending bull run. Lavish argues that mainstream media often portrays inflation as a temporary issue tied to supply chain disruptions rather than exploring deeper causes, leaving many uncertain about what constitutes a typical inflation rate and making it difficult to recognize signs of significant economic shift. At the same time, Bitcoin's role as an inflation hedge is gaining traction, especially in high-inflation countries like Ghana, Lebanon, and Venezuela, where it's becoming essential for wealth preservation. Furthermore, the growing acceptance of Bitcoin among institutional investors, aided by exchange-traded funds, suggests that the next bull run could be closer than many realize. Lavish believes that those who stay informed about these underlying trends will be better prepared for the market's next major shift. Watch clips from the interview to hear more about Lavish's perspective and his conversation with Bro.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Everybody's focused on the Fed and are they going to lower rates and what's that going to do? Is it going to help the economy? Are they going to lower fast enough? We've seen a lot of indicators that we are slipping into recession in certain parts of the economy. It's kind of like you've got two forces fighting each other in the economy. You've got the high interest rate forces from the Fed, and then you've got the high spending forces from the federal government. So this fiscal dominance that's been going on for a while now, since the beginning of last year, really, has been it's created kind of a dual economy. So you can see some people struggling, especially in the lower demographic, but then you see asset prices are still holding up. Home prices are still, very high at near their all-time highs or above in certain areas, at their all-time highs. And so, you've got kind of two economies that are going on. You've got the older demographic that have gotten a bump in Social Security, have gotten a bump in their asset prices, their stock portfolios, their home prices, they're borrowing against, they're spending, they've got a lot of cash they're sitting on, they're getting great interest rates on. And so that spending is still occurring. It's still happening. On the other side of the economy, you've got some of the lower demographic, the less wealthy, and they're struggling to keep up with inflation. The inflation rate has come down from over 9% to just 2.5% to 3%, according to calculations that are officially put out. The official calculations that we all know are not really official. But the reality is that those lower income families are really struggling. You're seeing that the impact to them on credit card defaults are up over 11%. There's something I just read yesterday is that, interestingly, the student loan payments that have restarted, there over 25% of those are delinquent, 30 days plus delinquent, which is interesting. And the reason for that, the federal government enacted a law or forced legislation to prevent reporting of those delinquencies for a period of time, and that is now about to expire. I think it's next month. And so when that does expire, the question is, how many of those student loans are still going to be delinquent? How many people are just, gaming the system and, I don't have to pay it this month because it's not going to be reported to the credit agency anyways. I've got another month to pay it. So that's a question we don't know. But it's a clear indication that there are parts of the economy that are struggling. And those parts that are not being funded by this excess, federal government spending on infrastructure and other programs that are not necessarily productive, but they're hiring people and they're spending money into, and which has become ultra clear in the jobs numbers. So the jobs numbers we're getting are conflicting also. So you've got this jobless rate, and you've got the job, the employment numbers that differ between the what the institutions are saying versus the households are saying. And so, and that gap is usually because of improper counting of jobs. And one of the big reasons for a divergence in what you're seeing with jobless rate and with the revisions that we keep having is that government spending and government jobs are really dominating the hiring lately. And so, again, that's kind of the frame of the economy. So the question is, if we keep spending federally and we keep feeding this engine with fiat dollars, even though it really is that's inflationary, does that enable a soft landing here? And if we do get that soft landing, how long can that last before we get into another crisis, another credit crisis?
James Lavish analyzes the current economic landscape, focusing on the confusion surrounding the Federal Reserve's interest rate policies. He points out public concerns about rate cuts as certain sectors show signs of recession. Lavish describes a dual economy in which high interest rates are balanced by increased federal spending, leading to diverse experiences across different demographics. He addresses the confusion surrounding inflation and Bitcoin, particularly among younger generations who often struggle to grasp inflation's complexities and its impact on financial well-being. Lavish criticizes mainstream media for downplaying inflation as a temporary issue, which fosters misconceptions about what constitutes a normal rate. Despite negative narratives regarding Bitcoin's energy consumption, its recognition as a hedge against inflation is gaining traction, especially in high-inflation countries. Lavish notes that institutional investors are increasingly engaging with Bitcoin, underscoring the need for more discussions about its unique features and investment potential. Now, let's return to the interview.
There's a lot of misinformation out there, as you and I both know, and we talk about all the time, that people are confused. And your normal investor, your typical citizen is not thinking about how the money is broken. And they're not thinking about, why is it so difficult for me? And inflation, like what exactly is it? What's normal? Is inflation normal or not? Well, people know, especially after the last few years, and those who didn't live through inflation in the 80s that are younger, they're seeing that inflation is not normal, because people your age are seeing how difficult it is to even amass enough assets to keep up with inflation, not only just to keep up with their expenses and the fact that their wages are lagging, but also just to amass enough wealth that it can keep up with the cost of housing. So we know it's not normal. People are feeling it's not normal, but they don't really understand why. And then they get confused by all the the mainstream media is confusing people, because they are at both times explaining how inflation is just transitory, or inflation is just because of the bottlenecks, because of the lockdowns, and it was difficult to get goods at the right prices, and and so there's confusion about whether or not the inflation rate should be 2% or 5% or 3% or whatever it should be. And the reality is that people are waking up slowly to the fact that inflation is not normal. And so, but at the same time that they're explaining away inflation, they're also even blaming it on the consumer. And on the other hand, over here, continuously printing articles, negative articles about Bitcoin, negative articles about Bitcoin energy usage and mining, which is a whole nother issue that is just completely untrue. And so that understanding has to come, and that's what's taking time. And it's just having conversations like this, people being exposed to something they haven't heard before, and understanding how Bitcoin really is different. And so that's where it starts. We're seeing it. We're in a world here, Luke, that Bitcoin is investment centric, right? So people are looking at Bitcoin and thinking, well, can I make money off of it? As opposed to if you go to someplace like Ghana, or if you go to, Lebanon, or Argentina, or Venezuela, or Egypt, places where you have high inflation, that people are looking for a place to put their money that is going to counteract those inflationary forces of their capital. So that's like it's a need. It's an immediate need for them, and their understanding of Bitcoin, their understanding of Tether, and how you move money around digitally is completely different from the regular world here, where people are just concerned with, well, number go up. Is it a meme coin? Is it like GameStop, a meme stock? Is it or is it different? And so that's where it starts. And then along with that, in this investment centric world, you've got the institutional investors. And that's a whole nother set of investors that are now finally being exposed to Bitcoin in a way that they haven't been able to be exposed before. And so those ETFs have been extremely important in that process. And it's just the beginning of it. It's just the beginning of them starting to understand and dig in and learn about Bitcoin and why it's different and why it should be allocated to their portfolio.
Bitcoin stands at a critical crossroads this week as it aims to reclaim the $69,000 mark, a pivotal move that could indicate the strength of the broader crypto market. Recent trends reveal that a bearish U.S. equity market and a strengthening U.S. dollar are negatively affecting crypto assets, with Bitcoin down 1.28% over the past day, mirroring a similar decline in the overall market valuation, which now sits at $2.31 trillion. Currently hovering around the $66,000 level, Bitcoin faces a crucial juncture. Analysts stress the importance of establishing a higher high above $69,000 to maintain a bullish trend. The $66,500 level is a key support line. A drop below this could trigger further declines to $65,000 or even $61,500. Focus remains on Bitcoin's ability to stay above these critical support levels while aiming for a breakout above $70,000. As of now, Bitcoin is priced at $67,500, reflecting a 9.44% decrease from its all-time high of $73,700 reached on March 14, 2024. As we wrap up, what are your thoughts on the complexities of inflation and its impact on financial well-being? Do you believe Bitcoin can effectively serve as a hedge against inflation, particularly in countries facing significant economic challenges? Please share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.